careful.
Alex, you are, I'm going to get the name right, the founder and managing director of Trader Training and Development.
Currently, yes.
And you work with institutional traders, and you also work with retail traders that are looking to
make the switch,
professionalize their trading as well. We're very glad that you're here. We want to welcome back everybody that's online. So we're broadcasting online, so you can say hello to everybody out there. And without further introduction, I'll turn the time over to you for about the next hour.
Thank you very much, Rob. Thank you very much. Thank you very much for having invited me to this event. And also thank you to FX Pro. And of course, a bigger thank you to all of you who have taken the time to come to this event. Truth is, these events wouldn't be happening without you, because there may be some organization behind it, but without you, this wouldn't happen. And I feel very nice to be part of this community, this trading tribe. And I say trading tribe and community because all of us here are different than the people outside of this room. And we are different in the sense that we are risk takers. We are proactive with our finances. And I think that's very good, in a sense. And let me show you exactly in which way we are different from the people outside. Most people in the world outside, they leave their house, they commute, go to work, spend time with their colleagues for about 8 hours. Then they have a boss to report to, they have customers, clients, and then they have to return back home. And then they have to do the same thing over and over and over again. It's commonly referred to as the rat race. And most people spend this for about probably 40 years, the 40 productive years of their life, doing the same thing over and over and over again. So the big picture is that these 40 years, these 40 working productive years are actually not actually 40 years. It's just 1 year relived 40 times over and over again. And okay, someone may argue that some people within this domain, within this space, have a career and they make some money, which is quite true. But as Lily Tomlin said, even if you win the rat race, you're still a rat. So what does this leave us? Retirement. Most people looking to retire look forward to retirement. This is the proverbial rule of 40. You work for 40 hours per week for 40 years to retire on 40% of what you were making. Roughly, I think. At least that's the theoretical part of it. But what do I say theoretical? Here's an interesting article from the Daily Telegraph on December 2017. And it says, UK state pensions rank the worst in the developed world. Here's another article. Daily Mail. Britain pays retirees the worst state pension in the developed world with a basic payout of 122.30 a week. Government projections suggest that for those under 30, the age when they can claim a state pension will have to be raised to 70. Here's comparatively to here where we stand. Netherlands has a payout as a percentage of average wage around 100%, and we are standing currently here, around 29%. By the way, this is an OECD study that was published a few days ago. Okay, someone may ask, all right, this is how things are now. I mean, the UK is a very, very well-developed economy, thriving one. Maybe things will get better in the future. Who better to answer this question than Baroness Altman, the former pensions minister? And if you allow me to read through the script, although I hate to do that, Baroness Altman wrote that despite a recent overhaul to the pension system, payments will need to be cut further to avoid massive tax rises in future to pay for it. She said, We're one of the world's leading economies, but our support for the oldest in society is not fit for purpose. In April 2016, major reforms to the UK state pension were supposed to have made the system affordable for the future, reducing its generosity. Beyond the 2030s, the new state pension will be lower than the old system for most people, and the lowest paid, predominantly women, will lose significantly from the new system. Despite this, the government has been advised that the costs of paying state pensions will soar so much over the next 20 years and beyond that further cuts will be required. Again, Baroness Altman, former pensions minister, this was published in Daily Mail 12th of February, a few days ago basically. So the old school model of the rule of 40, 40 hours for 40 years, has actually become the rule of like 50 or 60 actually, because we work 60 hours per day for 50 years to get 30%. All right, so the old system doesn't work. So what's the way forward? What can we do about it? Well, obviously, be a bit more proactive with our finances. Now, I'm not sure how many actually aware of the MTA, or actually it's called the CMT now, the MTA Association. All right. The MTA, for those that may not know, the MTA is the largest technical analysis association globally. It's been running for more than 45 years and has chapters all over the world. And I'm currently chairing the UK chapter. And I must say, and why am I saying this, that during the monthly meetings, and this is like a small pitch for the MTA, if I may be allowed, we have monthly meetings where we invite institutional traders, institutional analysts come working from bank and hedge funds, and they give presentations, and the presentations are for free. In any case, coming back to our presentation, I get approached by people, by attendees of these events, and they ask for a question. The most common question I get asked is, can you recommend to us a technical analysis book, some material to read? What's a good technical analysis especially to start out? And this is what I usually advise them to read. It's not a book, it's an academic paper. It's called The Cross-Section of Speculator Skill, Evidence from Day Trading. Okay, I will spare you the details of reading the whole paper because it's quite an elaborate study. It was done in Berkeley Business School in the United States, a quite well-known university overseas, and by Dr. Barber and Terence O'Dean, two very well-known academic researchers in the field of behavioral finance. And I've written a small synopsis of what it says. Okay, just 3 lines. Basically, the paper was a research of 360,000 day traders over a 15-year period. So it's a huge sample size for a very prolonged period of time. And what the 2 professors at Berkeley University did is study their profitability, or lack thereof. Now, before I show you share the study, the results of the study, has anyone heard before the common adage that 90% of traders lose? Has anyone heard this? Okay, most of the people do. All right. Well, I think the number is a bit exaggerated, and the study proves it. And the actual number is not 90%. It's 87%. 87% of traders, especially day traders, lose.
I think more than 87.
And yeah, it may well be. But at least as far as this study is concerned, is 87%. So by and large, this 90%, if traders lose, it's quite correct. And interestingly enough, what they found is that only 0.28%, basically 1 in 360, made money year after year. I mean, they were consistently profitable. And we're living in the age of information, people download podcasts and webinars and this and that, but still, 90%. But in my experience, I think the situation is much worse than this. In which respect? I think there is a downward spiral, that it's not just that 90% of traders lose, is what we have the rule of 90. 90% of traders lose 90% of their portfolio within 90 days. Because most of these day traders are dealing with the leveraged investments. So the results of their mistakes are magnified. So they lose their money very, very fast. But again, drawing from personal experiences from speaking with people, I think the situation is even worse. Because, let me put it another way, before you open accounts or before you listen to some kind of investment presentation, have you ever heard disclaimers that brokers or the government provides, asks people the firms to give out and say that you can lose more than your initial capital? Well, this is probably one of the few things that governments say, and it's true. Yes, you can lose more than your capital. Actually, 10% of these traders go bankrupt because they're over-leveraged and they lose more than their initial capital. And it gets even worse. Because of this, the immensely stressed financial situation that they got themselves in, some get divorced or even commit suicide. So, where does this leave us? Most people are trapped between the rule of 40 on one hand. So on this side you've got the rule of 40, which means people are trapped by inaction. So it's like being in quicksand. And then you've got this side, which is the rule of 90, which you've got the group of action, but they're like stepping on a minefield. So where does this relate to us? Because the fact that you are here means that you are not in the rule of 40. At least you're proactively trying to get out of it if you are there. So that makes you different. But you're also not part of the rule of 90, because if you had lost your money, again, you wouldn't be here. And although this situation is quite tragic, there is an irony in it as well. Which is the irony? This is a chart of the, I think it's the Dow Jones Industrials from the 1870 up until now. The irony is the following, that of course, there are drawdowns and bear markets, but by and large, the average annualized return since this beginning of the past century, the end of the past century, is around 10% per year if you reinvest the dividends. That practically means that you can double your money every 7.2 years. And that's the irony of it. So you've got a group of people who loses huge amount of money playing a game when it's rigged in our side, in our favor, on our favor. Of course, this money doesn't vanish. It just, the market is one huge wealth transference mechanism. It goes from the pockets of the people in the rule of 90 to the remaining ones, to the 10% club, what I refer to. And this is how it looks like. And in this sense, Hollywood and Wall Street are exactly the same. Because in Hollywood, you have a huge influx of people trying to make a career there, trying to become famous actors and get the fame, the fortune. And in the meantime, they work like part-time jobs to help themselves financially, support themselves during this effort. But by and large, most of them don't make it. And then you have a few right at the top, like the Brad Pitts and the Angelina Jolies and all the rest of them, who make millions and millions and millions. So there is this 90% rule of 90 in Hollywood as well, which is shared both across markets. I mean, acting and trading. So the real question is, why does this happen? So on one hand, you've got the rule of 40 people, say this part of the room, where they are basically trapped by their own fear and their own inaction. Their fear to take action, their fear of failure, their fear to be proactive. But the truth is that the real failure is realizing that there is no failure, there's only feedback. You fail only if you quit. And that's, in that respect, that's why we said this room is different than the people outside, because we are risk takers. So, this side of the room, the rule of 90, if you will, the people that loses a large part of their portfolio in trading, is not that uniform. Actually, there are two types of traders in this group. The first one is the ones that don't want to run the mile. That just come in totally unprepared. And to them, markets is like one huge slot machine. And then you have another group. These people do want to run the mile, but they just don't know in which direction to run to. And I think this is where it's relevant to people trying to have a proactive stance toward their finances. Irrespective of why you're doing it, some maybe do not want to give up their job and just have a trade for growth. Others may want to be trading for income. But the thing is, in which direction do you run to? We live in a digital age when you've got bombarded by information. But we forget that information is not knowledge. We're actually drowning on it. You go Google, you go YouTube, you've got podcasts, you've got webinars, you've got conferences such as this. And people are trying to get information from here and there. But by and large, most of it is disjoint. So it's like trying to create a puzzle without having the original photo, but it's even worse because the box that you are getting actually the pieces out from are actually the pieces from 2 or 3 different puzzles. You're trying to drink off of a fire hose. So my suggestion is go on a digital diet. Stop consuming. And to a certain extent, to tell you the truth, I don't blame people in this category because there is no blueprint on how to learn how to trade. If you want to do it professionally. Professionally, I don't mean doing it full time, but professional in terms of your mindset. Because your mindset dictates everything. For example, for the rule of 40 people, their mindset dictates where they are. If they do a mindset modification, then they will have different results. So, there is no blueprint, there is no step 1, we do this, step 2, we do that. For example, if you want to become a butcher or baker or a banker, you go to the appropriate school, whatever you want to do, and you have to pass exams and everything. But in trading, there is no such thing. So today's presentation is about giving you a blueprint, if you will, a skeleton, a rough outline of how you can join the information you have, how you can partition better the information you have inside you and the information you'll be getting going forward. So how do we create such a blueprint? Well, in order to start, I had to, in order to create it, I needed to follow some principles. The first principle in terms of learning is that if you want to be teaching something to someone, it has to be smart, I mean, it has to be sound, founded on reality. The second principle, it has to be simple, so it's understandable. And the third principle is it has to be systematic, so it's reproducible. So there are quantified guidelines, so each and every person can follow them. If they're taught to 50 different people, 50 different people will give the same answer. So we strive for consistency. That's the general framework. But let's try to be more specific. Step one. The step one I followed, there is a gentleman called Noel Birch in the States. I mean, he created these stages of learning. You may have heard of it. I mean, I think probably did about 20, 25 years ago. In any case, it doesn't matter what domain you're trying to be an expert or knowledgeable in, you go through 4 levels of knowledge. The first level is unconscious incompetence. Basically, you don't know that you don't know. The second level of competence is what's called conscious incompetence. That means you still don't know, but you are aware of your ignorance. The third level of competence is conscious competence, which means you've done your practice, but you still have to be thinking of the rules. And the third level of mastery, if you will, is unconscious competence, which means you have, through repeated practice, you have internalized the whole procedures and strategies so well that they have become second nature. And, example would be like, I don't know, Michael Jordan, taking a shot at the one of these famous buzzer beaters, right at the last seconds of a game. He doesn't have time to think, actually, when he was actually playing, still playing the game. Should I go this? Should I fade the opponent this way, or should I go that way? Should I do this? Because it's just so little time. But he done it over and over and over again. So he had reached the level of unconscious incompetence. That's the mastery. So if you want to develop, like a trader development system, you have to first have a clear view, where you are and where you want to go, because there are different levels of competency. Now, obviously, this model by Mr. Birch is very useful, but it has to be adapted for trading. So that's the first change I made. The second one is that it's too one-dimensional. It's a triangle. It's not a pyramid. It doesn't show you the dark or the shady sides of the pyramid. What do I mean by that? Let me elaborate on this one. Now, when we talk about, it's called what I call it's called as the iceberg illusion. Most people, when they think about success, this is what they see. Which stage they're on. And I'm referring back to the level of competencies model of someone who's reached unconscious competence. Oh, he's very good at whatever. It doesn't matter which domain or field we're talking about. But what they're seeing is just that. Just the result. So what lies behind just the tip of the iceberg? Well, obviously, the stage below, it's the skills that they have. Oh, he's a very good free throw shooter. He's very good at three-point shots, or whichever sport or music or whatever domain you want to apply. So these are the skills. And of course, the associated strategies he has used or she has used to acquire those skills. Of course, you're going a bit deeper. But I think there is something deeper below that. Is the mindset. What mindset do they have? I don't know how many of you have studied or heard about psychology. It's called the TEAR model, T-E-A-R. Basically, T stands for thoughts, what we think. is responsible for what our emotions are. What you think is what you feel. A comes from actions. What you think is what you do. And R is results. And what you do is, you know, what results you get. So mindset is of critical importance. Think of it of another way. Mindset dictates direction. As we saw before, the mindset, if someone goes down the rule of 40 group or the rule of 90, is dictated by people's mindset. And below that is motivation. That's the drive, how much drive you have. So the iceberg illusion, I wanted to include that into Noel's model and create something of my own. And this is how it looks like. I wanted to see what's motivation, creates a certain mindset, and that brings people to a certain stage of competency, of knowledge, what skills they have to acquire, and what's the symptoms, the results they get, whether it's monetary or otherwise. And I say it's symptom because it's just the tip of the iceberg. Of course, everyone, like I mentioned before, everyone is concentrating on that, but there is, you know, the iceberg, the rabbit hole goes much deeper than that. So let's begin to examine this in a bit more detail. The skills that are needed form the acronym S.M.A.R.T, coming from the bottom down, because obviously you ascend in different stages, what I call the core 4 stages of trader competency. And the skills that we have, again, going from bottom up, form the acronym S.M.A.R.T. And there are 5 of them, although the stages of competency are 4, because the second one needs 2. Now, the top of the pyramid is blue because that's where profitability lies. The bottom is gray because then, you know, rule of 90 stands there. So let's begin. So what happens? Again, someone may be motivated to, you know, is tired of being in the rule of 40 and want to be more proactive with their finances. So what do? Open up a brokerage account. So how much motivation do they have for trading? 0. But why is it 0? It is 0 because they're at that stage, they're not interested in trading. They're interested in getting rich quick, to make a quick buck. They're interested in having the Ferrari fantasy, the tropical island syndrome, as I call it. So they open up a brokerage account, they put a small amount in, actually let's see it in more detail. These are the most classic mistakes and mindset. So when people start, they are very, very confident. They want to be putting 1,000 pounds in their brokerage account and make 1 million pounds trading the 5-minute chart for 30 minutes. But of course, we all know it takes at least a couple of hours to do that. And actually, if you check on the ECB website, there is I forgot to attach it to the presentation. Citibank has made a very interesting study. You can find it on the ECB website, the European Central Bank, on the profitability and motives of private investors. And it says that they did a survey and they found that when they just start out, 84% of them believe that they will be profitable. It reminds me of the other statistic that we have in Harvard first year students, when they were asked how many thought that they would be top percent of the class, and 80% of them said they believed that they would be. So they begin with a huge amount of overconfidence, they put some money in their account, and they begin trading. Now, at this stage, I don't think that these are trades. This is what I call charity trading. Because basically, with each trade you make, you're donating your money to the other counterparty. Now, of course, there are some people in between, like brokers, exchanges, who keep part of the action via commissions and exchange fees and so forth. And believe me, each time you trade, they have a party. So this is the stage of charity trading. So each trade is a donation. The second part is what we call to revenge trading. Now, this is when people get really angry with the market. They feel angry at the mistakes they have made. Now, of course, there is a switch. There is a slight change of modification. The modification from trading to make millions, return of capital, they focus on the return on capital. Sorry, return on capital becomes a nightmare of return of capital. Now they start focusing, how can I get my money back? And then as the charity trading continues on, and they reach a terminal point, they start with the conspiracy theories. It's always them, they got my money. Who is they? It's someone else's fault. It's the government's fault. It's the broker's fault. It's hedge fund traders' fault. It's someone else's fault. It's always someone else's fault. But fun, isn't it? It's always someone else's fault when it comes to losing trades. It's never someone else's fault when you have a profitable trade. Have you ever heard someone say, oh, I had a very stupid position, but the market moved my way, and I accidentally made money out of it? I don't think you will ever hear that. So these are the mistakes that people do in stage one. What's the mindset behind it? Get rich quick. So this is the first stage that people reach, of a gambler. People here are not traders, they're gamblers. So what's the first skill we need to acquire? S, for self-awareness. We have to create a blueprint, a roadmap to set our targets and answer some very important questions. The first important question is, what kind of a trader do I want to be? The second is, why am I making these mistakes? And how can I correct them? Of course, I have created some steps more concrete, but I'm just giving you the general outline of what self-awareness is. Actually, it's been systematized via what's called the GROW model. G for goals, R for realities, O for obstacles, what's standing in my way, and then W for will to win. Basically being an action plan. So what's the result? Anger, and of course, losses. At this stage, people have lost, I think probably, I don't know, safe to say around 50% of their portfolio. And they're at what I call the drawdown death spiral. They are at the controls, but they're not in control. 60% of the market finishes at this stage. And if you consider that as a trader you have 4 types of results you can achieve, win big, win small, lose big. At this stage, people have lost small. And they lose small because they've taken their losses and they said it's their fault, and they get angry and they jump onto another get-rich-quick scheme. It might be property, it might be, I don't know, internet marketing or whatever is in fashion these days. So that's it, trading is on for them. So they take a small loss, small comparatively, and they run off. At this stage, you have to make a conscious decision. Do I stay in the game or do I quit? So some people's motivation elevates a bit from 0 to being interested. They're interested in markets. Now their motivation is to learn more. So what are the usual mistakes that people make here? And of course, what's the underlying mindset? The first thing they do is go to a forum. And they start, opening up an account, my name is trader, 666, or super trader, and we're talking to galactic trader number 888, and they start exchanging heated views about market direction, and I think this will do this, I think this will do that. And the discussions get so heated, it's like discussing politics or religion. And the reason that happens, because at this stage here, people are not interested in profits. They're interested in becoming a prophet. They're interested in being right, not making money. And of course, it's a classic game of, the blind leading the blind. So what's the usual next mistake that people do? they switch time frames. Obviously, since you can't make money on the 30-minute charts, they say, okay, I'll try to spin the wheel more often and trade on the 5-minute chart. Maybe that will make me more profitable. So they start continue with the aforementioned charity trading, and they're losing at a faster pace, and again and again and again and again. Or maybe they switch to a lower time frame and say, oh, I'm going to be spending more time with the family. So what's the next mistake? Usually switch products. So they go from futures to options, to binary options, to CFD, to spread betting, to Forex, to what it's called cryptocurrencies, and this and that. So they go from, oh, maybe I'm being more profitable if I trade options. Maybe I'll be more profitable if I trade stocks. So that doesn't work. So in the meantime, the charity trading continues on and on and on and on. So what's the next thing to do? Switch markets. I'm trading the DAX, the FTSE, or the Eurodollar, and that, I'm not very profitable on that. I'll try to do natural gas. Maybe the market will be more merciful to me, trading natural gas. And of course, that doesn't work as well, and the losses continue. In the meantime, you may go for the option of refunding your account. So what's the mindset behind that? DIY. People have a DIY mindset. At this stage, people are still not traders. They're hobbyists. Trading for them is a hobby. They're trading for amusement. So what's the skill they need? The first skill they need is market knowledge. Learning how markets move, learning what I call the core four of price structure, which is like trend, momentum, volatility, relative strength. Unify them and create what I call a core four chart checklist, a systematized way to look at the chart. Because when you check out the market, you should have a procedure, sort of like being an air pilot. When they go into the plane, they have a procedure to follow. So you should have something the same. Do it over and over and over again. A systematized procedure to look at the chart. And learn how markets move. But still, that's not enough. Because learning about the ingredients does not mean you have a recipe. What we are doing here is learning what the flour, the butter, and the milk is. We haven't learned how to put everything together in terms of something more concrete. We're just learning how markets move, getting market knowledge. So if someone is brave enough to continue through adversity, they continue with their journey, and the first thing they do is say, okay, maybe I need more knowledge. So what I'll do is I'll get an ebook. One of these you get for $9.99 or some very low price, and they have usually a very, very impressive title, The Secret of the Galactic Hedge Fund Managers Who Make Millions Trading the 5-minute chart and so forth. So you get a downloadable ebook, and obviously, not much value information is there. So I say, okay, I'll open up the budget a bit. I'm bleeding through the ears, so I might as well get something for it. So they buy a technical analysis book. And they end up with something like this, what I call Christmas tree charts. When you've got so many lights and blinking, indicators and this and that, and everything is on top, and it's literally like looking at a Christmas tree. So obviously, this doesn't work, and you say, okay, I can't figure this out because one book says this, and then the other book says that, and then he said this and he said that. Again, like I mentioned, there's all the information that you hear is this joint. So what do? Okay, I'll go to a magic pill seminar when I'll solve the keys to the kingdom, and you get analysis sort of something like that. Oh, the GPP is approaching significant area of resistance. The lower end of blah, 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 you get an inverse head and shoulders and long-term bearish trend line and Fibonacci retracement and candlesticks and blah, blah. These are the keywords that you usually sort in these sort of magic pill seminars. Support, resistance, head and shoulders, trend lines, retracements, and candlesticks. And then obviously, since it doesn't work, they go for the solution of EAs and signals, current competence. They take their umbilical cords and look for a place to plug it in. And they say, maybe someone else can trade for me, and Q will give me the signals. And I can trade what they say. Well, obviously that doesn't work, and the bleeding continues. Again, what is the mindset behind it? Again, DIY mindset. So what do we need to do? What skill do we need to acquire? For a trading plan. We need to take the information that we previously got into a trading plan. But, of course, this trading plan has to have certain characteristics, what I call the core 4 parts of it. And at the very least, the ideas you have, it should be back-tested. And back-tested, I mean, verified. Not manually or visually, but systematically. Okay, so let's suppose someone did the self-awareness and did the market knowledge and got the trading plan and everything what he did perfect. Would they be profitable? No. And that's where you reach the point of despair. And that's again the irony of it between the tragic part, because people here have lost little. They lose small. People at the next stage, although they have more knowledge, they've lost big. Why? Because they've probably refunded their accounts and they continue with the charity trading and so forth. So their losses have mounted up. So ironically, although they know more than the gamblers, the hobbyists have a larger amount of losses. But why does that happen? Because I think this is one of the biggest scams in the industry. The trading plan or trading strategy myth and misconception that if you're given a trading strategy, you will become profitable. No, you will not. Because it's like, and that happens for the same reason that if you run if I give you a treadmill, you will not become fit. Having a recipe does not make you a cook. Or as the Trading Truth by Tyson, as I go to say, everybody has a plan until they get punched in the face. Having a trading plan and education and execution skills are two completely different worlds. And you're being sold this dream that if you get the trading strategy, the perfect trading plan, you will become profitable. No, you will not. It takes a lot more than that. And what is it that is needed? Well, at the first stage, you need to increase your motivation from interested to committed. But what does commitment practically mean? It means seeing your losing trades, learning from them, and being prepared to work. Because what most people do is they come to a workshop or a seminar like this, they get the information. Oh, I've kept notes on Alex's or Rob's or anyone else's suggestion. Yeah, that's very good. And they take the information and they put it on the shelf of their bookcase. But that's not self-development, that's shelf development. And they go back and they say, that was a good conference. And they come back next year to get their little fix. So you need to increase your commitment. And you also need to increase your mindset, to elevate it, to a do or die. Do it professionally. Do it like a professional. Doesn't mean it if you do it trade on a part-time basis, but treat it professionally. And this is when people become traders. At this stage, at the hobbyist, you're not trading, you're throwing the dice. At this stage, at the hobbyist, you're just putting on trades. You're still not a trader. It's now that you become a trader. So what skill do you need? Repeat and review. All the unsexy parts, the boring parts. For example, the first thing you do is like open a demo account. Now, of course, there are tricks around it and how you can use it properly, because someone may say, okay, it's not the real thing, and I would say, I would partly agree with it, but you get 80% of the experience with 0% of the risk. I mean, when you go to become a pilot, they don't put you up on the plane, you go on simulator, right? How would you feel if you were boarding a flight and the pilot was flicking through a book and saying, how to become a pilot over a weekend? You wouldn't be feeling too comfortable, would you? Or the same thing if you go to medical school. Medical students, operate on cadavers, and so forth. So this is the unsexy part, but nobody wants to become trade on a demo, because you can't make money on it. Everyone wants, to trade live. The second thing you need is what I call, actually it's not me, I'm quoting Larry Williams, a very good friend of mine. It's the most important book you will ever read. Your trading journal. But nobody likes to keep trading journals. It's like accounting. Hope we don't have any accountants here in the room. But I hate it. Just get everything and just pass it on to them. Really, just note down where we got in and got out, and man, we lost. And imagine that if you want to be doing it properly, you actually have two types of journals to do. One is an action journal, where you got in and where you got out. And then you have a thoughts and emotions journal, trying to explain and write where you got in and why and so forth, what we were thinking in the process. So it's double the work. So what's the third thing you got to do in order to take the skills at this level? The third thing is psychology. The difference, the mathematical difference between your trading plan, if you put it in math terms, your trading journal minus your trading plan, the differences between these, what you were supposed to do and what you actually did, the residue is psychology. A lot of people think that, I lost because of my psychology here. No, you did not. You lost because you didn't know what you were supposed to be doing. All right? And that affected your psychology. 2 minutes. All right. At a later stage, you lose because you know what you do, and then you simply don't do it. So then it's a matter of psychology. In any case, let me speed through, because I got carried away. And that's how you build discipline. What is called repetition-based discipline, because you do the same thing over and over and over and over again, and you do repetition-based discipline. So the fourth level is passion, because we have 2 minutes. And you have to increase your passion. Now, at the third stage, people trade for part-time, and then your mindset here becomes lifestyle by my own design. I won't be following the rule of 40. Now you become a professional. And what's the skill you need here? Transformation. You go out from becoming a pure techie, a pure chartist, look at the fundamentals and so forth, a lot of data you can look at. And the result is confidence, experience-based confidence. So as we can see, your learning curve is the same as your earning curve, and that affects your psychology curve. Psychology is called the Dunning-Kruger effect. So basically what you know affects how much you have, and that affects your psychology. And with that, I would like to part, because it's time for me. And this is my small advice to you. Change your mindset, change your trading, and then change your lifestyle. Thank you very much.
Thank you very much. All right, don't move.